There's been a spectacular rise in options trading, particularly zero-day-to-expiry options, and this has led some people to say we're going to get a repeat of 2018, a period called Volmageddon, when huge derivatives bets destabilized the regular stock market. So in this video, we'll look at what zero-day-to-expiry options are, how they could destabilize markets, and whether this is going to lead to Volmageddon 2.0. This video is sponsored by NordVPN, which lets you securely connect to the internet across all of your devices from anywhere in the world. So let's look at Volmageddon in a bit more detail. Let's begin with the mechanism by which markets get destabilized. Now, markets are always moving up and down, sometimes prices will fall, and usually what happens then is that people see opportunities. In other words, they buy and that pushes prices back up. So this is just a natural stabilization mechanism for markets. When things go wrong, however, is when selling begets more selling. In other words, prices fall, that leads other people to panic and sell, and then we get this self-perpetuating positive feedback loop where markets continue to plummet. So any mechanism which creates forced sellers when prices fall is itself going to destabilize markets. So remember that for later in the video. Now let's turn to the events in 2018 and Volmageddon. Now 2018 was actually the end of a very quiet period when stocks were generally trending upwards and volatility was low. Now there'd been a huge pickup in interest in buying exchange-traded products that let you buy or sell volatility. So you could go long VIX, profit from volatility increasing, or you could go short VIX and profit from volatility falling. But what happened in February of 2018 was that VIX, the fear index, spiked massively, and this caused lots of problems. And the reason for these problems was that these products were so popular. Now, some people really won big from going long VIX. So you can see that people who went long volatility via VIXY gained over 100% over the course of a few days, whereas people who were short volatility, a profitable trade up till then, lost 90% of their investment almost immediately. Well, you might be thinking that's all fine, but how would it affect me? Well, the problem was that this bled over into the normal stock market. And that indirectly was because of the hedging activity going on behind the scenes. And that was both in the VIX futures market, which you can see here on the left-hand side, because every day at around 4 o'clock when markets closed, these VIX ETPs had to rebalance. They bought and sold VIX futures in order to have the right notional for the next day. But notice what also happens is the price of E-mini contracts, these are futures on the S&P, fell very rapidly at the same time as the net asset value rose for these VIX ETPs. Because not only could you buy long or short exposure for VIX, you could buy leveraged 2 times or 3 times exposure to VIX. And the managers of these VIX ETP contracts, the leverage ones, were buying at around 4 o'clock that day, as were the people who were short. Those people had made losses and they needed to buy contracts in order to cover those losses. So there was huge simultaneous buying of VIX futures, and that had a knock-on effect for volatility in the normal stock market. And this had some fairly major repercussions for companies like Credit Suisse, which was sued for losses because of one of their VIX exchange-traded products. So the Velocity shares daily inverse VIX short-term exchange-traded note sank by more than 90%, and consequently Credit Suisse withdrew the product. And as you can imagine, this caused a lot of investor anger when the product disappeared. So this is a pretty clear case of the derivative tail wagging the normal stock dog. Before we go on, let me quickly tell you about NordVPN, which is sponsoring this video, which lets you securely connect to the internet across all of your devices. Now, personally, if I'm connecting to my brokerage account, if I'm out and traveling, I really want to be sure that that data is encrypted, and NordVPN provides that extra level of encryption. That means if someone is trying to find out my passwords or see what transactions I'm doing, they just won't be able to do it. Another thing I use it for is that if I'm abroad and I want to connect to entertainment back home, I can do that as if I was logged in back in the UK. And NordVPN is really fast. I've never had bandwidth problems because of the fact I was using NordVPN. If you use it on your mobile phone, it looks like this, so that you can find a map of Europe and you can choose which server you log into. So here you can see I'm logged in from a server in the UK. Connecting to NordVPN is really easy if you've got an extension built into your browser. Just click on the extension and click on Quick Connect. And that's it. All of my traffic is now encrypted and I can browse safely. If you use a PensionCraft, get a special deal from NordVPN, just follow this link beneath me, which you'll also find in the description, or use our promo code, PensionCraft. Recently, there's been a surge in zero-day options trading, and this has been part of a more general increase in options trading volume. And recently there was quite an important event, which is that single stock option volumes were bigger than share volumes for the first time ever. Now, zero-day-to-expiry options are just options. These are options to buy a particular stock or a stock index at a particular price at a point in time. What's special about zero-day-to-expiry options is that they have less than 24 hours to run. And if we look at the volume of traded zero-DTEs, which is what they're abbreviated as, you can see that it really picked up in the last 2 quarters of 2022. Now you might be thinking, who's buying this stuff? Is it retail investors like you and I, or is it institutional investors who are professional money managers? Well, it turns out that the majority of derivative trading is done by institutional investors. Retail investors only make up 3% of the options market by trading volume. But in the 0 days to expiry options market, they make up twice as much, 6%. But still, this is a market dominated by hedge funds, pension funds, not mom and pop investors. So you're probably thinking, what's the attraction? Why would you buy these things in the first place? So let's take an example, which is October the 28th, 2022. Now this was a fairly humdrum day in the stock market. In fact, it was quite boring. The overall index, the S&P 500, only rose by 2.4%. But say, for example, you'd bought 3850 calls expiring in a day. At the beginning of the day, they'd have been worth $2.90. At the end of the day, those would have been worth over 1,000% more, at just under $46. So in other words, you didn't have to pay much to gamble that the S&P would rise above 3850 that day. And if you get it right, you get a huge payoff. So there's a lot of leverage built into these products. Is it a sure bet? Well, of course not. With high return comes high risk. So let's look at the following trading day, which was October the 31st. That day, the S&P fell very slightly, 0.3%. And let's say you'd bought 3750 puts. At the beginning of the day, they were worth about $24. By the end of the day, they'd lost 97% of their value. They were worth just 65 cents. So it's almost like flipping a coin. Is the S&P going to end above this level or below this level by the end of the day? So make no mistake, this is not investing, this is gambling. So we know what zero DTEs are. How can this lead to Volmageddon 2.0? Well, this is the guy who popularized the idea. This is Marko Kolanovic, who's an equity strategist at JP Morgan. And he points out that the notional exposure to zero DTEs right now is close to $1 trillion. So this is potentially a systemically important market. And what he says is that it's not the people who buy these zero DTEs directly who are the problem. It's the market makers who sell them the options. The reason being that they have to hedge their positions in the underlying stock market. So those are the people who create the link between the derivatives and trading in the underlying stocks. So they are the people who create this instability in stock markets. How do the mechanics work? Well, let's assume for a moment that we've got more option buyers than sellers. The option market makers have the opposite position. They're the people who sold the options after all. So from their point of view, they've sold more options than they've bought. Now let's assume that there's some kind of trigger event. It could be an inflation surprise, it could be a geopolitical shock, but the overall effect is that it makes the stock market fall. And the consequence from the point of view of the market makers is that they have to sell into that falling market. And that's in order to hedge their positions and reduce their risk. So this is what's going to destabilize markets. Market makers have to sell as markets fall. So how does this matter to you and I? In the top panel beside me here, you can see the S&P 500 drawdowns since 1990. That's how much the S&P has fallen since its previous all-time high. Now, if you're a day trader, some of these single day falls could be catastrophic. But if you look at it from the point of view of the long-term investor, these shakeouts can be huge buying opportunities. That's because valuations at these points went very low. And if you're drip feeding into the market, that can really boost your long-term return. So if you do look at these very severe drops, notice how the volatility tended to be high. So it was above 40% in the dot-com bubble, it was above 80% during the global financial crisis sell-off, and in the short sharp shock in 2020, it was over 80% again. What's really characterized 2022 is an orderly sell-off, with no really big shakeout in the US equity market, such that valuations are still pretty high. So I think this might not be a bad thing if we do get these much bigger drawdowns and other people can enter the market at a much lower price. And there's a really interesting quote here from an institutional investor. This is Ronnie Israelov, who's the CIO of a wealth manager and DVR. And what he says is that if he has monthly options, he gets 12 independent bets per year, weekly gets 52 bets, but daily gives him 252. And if you're generating strategies, the ability to have more at-bats, or in other words, more goes, and more diversification by taking more independent trades can be useful. Now, if you're cynical about active management outperforming, you could say that this would just be 252 opportunities to underperform. But you can see why institutional investors find these 0 days to expiry options an attractive market. Another really important point is previously we assumed there were more option buyers than sellers. What if we reverse that? What if there are more option sellers than buyers? Well, that means that the market makers who are on the opposite side of the trade, instead of having negative gamma, now have positive gamma. Well, now if there's a triggering event which makes markets fall, the market makers are long gamma so that they have to buy. In other words, they're dampening volatility. They're buying into a falling market. And apparently in many markets, this has been the case. Institutional investors have been selling options in order to pocket premium and generate extra yield. So I don't think it's necessarily true that having lots of 0 day to expiry options is going to lead to Volmageddon. In fact, it might have the opposite effect and dampen and stabilize markets. So I hope that's given you a bit of insight into how 0 day to expiry options work and how they could destabilize markets, although as we saw, they may well be doing the opposite right now because there are more option sellers than buyers. So that means that maybe they actually dampen volatility. Now, don't forget our offer from NordVPN. If you want to be able to browse the internet securely, you can do that with a special discount. And to learn more about that, there'll be a link in the description beneath me. And as always, thank you for listening.